Hey everybody, Marty Missouri here, March 23rd, 2024 with your weekly economic update. Going to talk about the latest score of our PWA index. We'll look at a few inputs. We'll share some supplemental information and we'll look at some earnings call commentary to kind of get a gauge for where we are overall with economic conditions and of course markets and the implications and so forth that go with it. So as you can see here, things are looking better. No ifs, ands, or buts about it. Our index jumped about 10 points this last week, and I'll show you where it improved to only a negative 8.5. Now, below zero still tells us that recession odds are too high for comfort going forward, but nevertheless, this is a notable improvement. So lots of that strength came from the housing market. In front of you is the latest data on housing starts, and you can see that's moving in the right direction. The latest data on housing permits, and you can see that continues to trend in the right direction, and we're seeing a pickup in single-family housing, which is what we're really keyed on here. And home builders are now answering their monthly survey in a manner that says that the space is now expanding once again. That's the white line right here. The sentiment score was a 51. Above 50 denotes expansion. Below 50 denotes contraction. The purple line is how the survey scored in terms of estimates for future sales, and the orange line for estimates of current sales. So lots of optimism building in the housing space. However, prospective home buyers traffic, folks, I presume walking into model homes and so forth, is still at 34, and that historically, while it's improved from the previous month, it's still historically a very low rate. But a little bit of mixed signals, but certainly a net positive coming from housing sentiment. Truck tonnage saw a really nice pop this last month. Now, we did have really rough weather to start the year, so I do believe some of this is just basically trucks hitting the road now that they can. And by the way, that positive housing start spike would be influenced by an improvement in weather from what was pretty much stifling conditions earlier in the year. JP Morgan's global PMI index continues to move higher. We moved that from neutral to positive. So Purchasing Managers Index, that's what PMI stands for. And these are those monthly surveys that talk about how they see current and go forward conditions. And I'm going to give you some detail on the S&P's U.S. Purchasing Managers Index, which just came out recently as well. And then our index of leading economic indicators to coincident economic indicators ratio. It is in a territory where it's never been without being in close proximity or in the middle of recession. However, it is beginning to improve, as you can see here. And when we separate the two components, and this is the move on a year-over-year basis, you can see the leading indicators beginning to turn up. Coincident indicators have just a slight uptrend there as well. So, does this mean that recession is essentially off the table? Well, indeed it could, but is it unusual to get a spike, for example, in leading indicators as we are about to head into recession? Well, you can see we did get a small spike right here before going into the Great Recession of '08. You can see just months before the tech bubble recession right in here. You can see that we got quite the spike in leading indicators. You got a little bit of flatlining here before the early 90s recession. And then you can see, or not so much into the first recession of the 80s, but a huge spike before he got into the second one. Now, folks, I spent time on this last week on the last video, and I talked about the fact that it wasn't all that long ago when this right here, these two back-to-back recessions were a huge concern, if not the primary concern stated by the Fed, and that is they don't want to get soft on monetary policy or loosen or become accommodative too soon, because if inflation comes roaring back, well, then they're going to have to tighten. And when that happened in the 80s and to some degree here in the 70s as well, it turned into a much harsher recession than the mild recession that panicked them into cutting interest rates. So we are beginning to see signs that inflation is coming back. But it is interesting that they seem to have abandoned that talk. They are all in on the soft landing. And while I appreciate that, and I understand why, there's some historical precedent that says maybe we shouldn't let the pigeons loose just yet. And just to kind of confirm a bit what we're seeing, the Economic Surprise Index that Citigroup puts out, this one's for the U.S., you can see it ticked up a little bit, meaning just the last couple of weeks, the data have come in a bit better than what economists had previously anticipated. And I pulled up some other things as well. So we have other indicators that we put together. One is our financial stress indicator, and this is a component there. And the orange line is the 2-year Treasury yield. The white line is the Fed funds rate. The Treasury yield is considered an indicator of where Fed funds are going. You can see where I've shaded areas here where the Fed funds rate was actually higher than the 2-year yield, meaning the 2-year yield was responding and anticipating even hikes in the Fed funds rate, but then began to roll over as the economy rolled over, anticipating cuts in the Fed funds rate. So you can see that was happening here as inflation was coming down, as the economy was rolling over. Uptick here reflects some newfound strength in the economy and some inflation pressures, no doubt. But I highlighted these to show you what the market did when each of these, save for a couple, which I'll point to, periods unfolded. So here we were before the COVID recession. And remember, our recession light got lit 6 months before we knew about COVID. But and also you can see what was happening here as well. And that was a 35% swift decline in stocks. Here we were before the '08 recession, and you can see a massive decline in stocks. Here we were before the tech bubble burst, massive decline in stocks. Here we were before a 20% correction in 1998, lasted just for a little while. Here we were before the 90 recession, stocks were down 20%. And here's those back-to-back 80 recessions, and then the bigger one and the bigger bear market that ensued. This indicator of ours was flashing before each of these. Now, if you look really closely, you can see that it actually got there for a minute right before the '87 crash, which was the biggest one-day decline, percentage-wise, I think, in history. And then here you got it as well, just a little bit. And this is that soft landing that all the people who are just desperate to be bullish on the market, on the economy, keep pointing to. So they say, it happened in 1995, it's going to happen again now. Well, yeah, they had a Fed funds rate that was rolling over. We had a 2-year yield that was rolling over. Typically, the Fed begins to cut when there's trouble coming, and typically they don't get to, save the world from recession. Clearly, it's anticipated now that they're going to succeed, but looking at the data, looking at history says, too soon again to back up the truck right here. Now, you might want to do some things, and we might do some things incrementally to recognize this positive development in our core portfolio, but way too soon to back up the truck just yet. And here's that supplemental stuff I wanted to pull over. So we use the Institute for Supply Managers, PMIs, in our index scoring, but Standard & Poor's does their own purchasing managers indices, and theirs has been more optimistic than the ISM's. So here's the latest on U.S. manufacturing. Anticipated to be 51.8, but the actual results came in at 52.5, creating some space from the dividing line that separates expansionary from contractionary conditions. Future output estimates, you can see that's moving in the right direction. Employment, big time. Looks like factories are hiring right now, right? On the services side, however, we are seeing a bit of a deceleration in sentiment, which is interesting. However, service providers are still generally optimistic about the go forward. Now, here's what we should be concerned about with regard to inflation and Fed policy. Prices charged, big pop this last month. Output prices, big pop this last month. Now, if the economy is improving and companies do indeed have pricing power above the overall inflation rate, well, then that's good for margins, right? And that's actually bullish for the stock market. The question is the Fed going to be able to stay sanguine if this continues to heat up? And that's the problem of the early 80s that, I'll say it again, the Fed was uber concerned about not that long ago. And conveniently, they're not voicing that concern right here. Okay, let me just paraphrase for you from one of our premium research providers, Peter Bookvar, as I've done many times here of late, his work on earnings commentaries. So let's just start with positive commentaries of the last week. General Mills, moderating inflation, reduction in supply chain disruptions, and increased U.S. consumer confidence, bolstered by wage growth and a strong labor market. Those are tailwinds. Specifically on inflation, it's 4% now. It was double digits last year. And long term, it's been kind of 2% to 3%. KB Homes, the spring selling season is off to a very good start, which together with our considerable backlog, better build times, and planned new community openings, gives us confidence that we are well positioned to achieve our objectives this year. Micron Technology, AI memory business is doing great. Elsewhere, in personal computers, after 2 years of double-digit declines, unit volumes are expected to grow modestly in the low single-digit range for calendar year 2024. Turning to mobile smartphone, unit volumes in calendar 24 remain on track to grow low to mid-single digits. Turning to auto and industrial, the automotive sector continues to experience robust demand for memory and storage as non-memory semiconductor supply constraints have eased and as new vehicle platforms have launched. And then Bookvar says his favorite earnings call related exchange came from J-Bill from an analyst that said, "I was trying to count how many times you mentioned AI in your prepared remarks, and then I just lost count." The CFO responded, "Just to be clear, I said AI 21 times in my report, so I did count." So folks, clearly, companies are leveraging this whole AI thrust, mania, whatever you want to call it. And if you can tie yourself to AI, it tends to be very bullish for your stock price. This is one of those things that is too reminiscent of the internet in the late 90s. In my candid view, I do think there is a bubble in AI stocks. Notwithstanding the fact that these are good companies, they are seeing good results, and it's a different setup in that regard than many of the dot-com companies. But even legitimate internet companies that you could bet were going to last saw massive drawdowns during the internet bubble. Cisco went down 80%. And by the way, it's still 38% below the high leading into that bubble. So Cisco would be a great company. That's also a vivid example of what can happen even to a great company stock when the market just takes it beyond any semblance of fundamental reality. Amazon went down like 95%. And it was years before it got that old peak back. So these are just things that we just need to not pretend aren't real in terms of the risk out there. And that's actually it in terms of the positive commentaries. In terms of the negatives, so Federal Express, looking now by geography, in the U.S., conditions have been weaker than we anticipated. And internationally, we continue to see softness. Nike, we are prudently planning for revenue in the first half of the fiscal year to be down low single digits. This reflects near-term headwinds from lifecycle management and our key product franchises, more than offsetting the scaling of new products as we shift our product portfolio toward newness and innovation. This also continues to reflect the subdued macro outlook around the world. Lululemon. As you've heard from others in our industry, there has been a shift in the U.S. consumer behavior of late, and we're navigating what has been a slower start to the year in this market. We're seeing a slowdown in traffic in the U.S. Darden. The quarter started well with strong holiday performance in December, but unfavorable winter weather negatively impacted January traffic. And while February results improved, we experienced some underlying softness we had not seen in the months leading up to January. The lower income consumer does appear to be pulling back, and the mix of guests based on income is now in line with pre-COVID. Winnebago. We anticipate industry softness in the fiscal Q3, particularly on the motorhome, RV, and marine side, amid continued dealer caution. Signet Jewelers, as anticipated, we saw a late shopper this holiday as value conscious consumers were holding out to get the best deals and had one extra weekend to shop for gifts. Similar to Christmas, Valentine's Day shoppers were late and highly value motivated. January and early February trend was quite soft. Chewy. In 2024, year-over-year growth for the industry is expected to be lower than historical average. General Mills, they talked about some tailwinds, as I mentioned a minute ago, but they also talked about some headwinds. First, we've seen an increase in value-seeking behavior from customers, affecting both the channels they shop and the size of their basket. From Accenture, we see clients continuing to prioritize investing in large-scale transformations which convert to revenue more slowly, while further limiting discretionary spending, particularly in smaller projects. So folks, yes, again, the data is improving. However, prices are rising with that data. That's one thing we need to be very cognizant of right here. But also, as I've just read from you, on the street, I think you could argue that we're seeing somewhat of a deterioration in what a lot of these companies are reporting and what they're anticipating. Now, I do believe that we need to take the positive seriously, and we are certainly not above in the relatively near future expressing that to some degree, even if just at the margin, within our core portfolio and taking on more exposure that would benefit from an improving economy going forward. This could indeed be that soft landing. We think that path is still very narrow. Lots of people are adopting it. I will say this, the recession call is no longer consensus. And folks, that's always when it happens. Remember, I told you one of our analysts who said no recession in 2023 is now anticipating one late this year or early next year. Again, we have to remain open to all possibilities. As I said in the last video, a couple of analysts who I have a great deal of respect for do not see a recession coming. Clearly, as I've expressed, that's not our base case. But I am probably spending more time right now exploring their case than I am the recession case because we need to know where we might be wrong. And as I showed you earlier, our own recession indicator is moving towards the positive line right here. So folks, lots of moving parts, huge mixed signals, as I just shared with you in the earnings commentary. But definitely a time to stay on our toes, continue to stay very diversified, continue to hedge against something meaningful to the downside. There is massive leverage in this market, particularly in the derivative space, that could ultimately, if something breaks, be pretty precipitous to the downside in terms of stock market action. So folks, I will leave it right there. Hope you have a great rest of the weekend. I apologize for the scratchy voice. Got a little bit of a cold, but all's good. Thank you, folks, as always, for watching and listening. Talk to you soon. Bye-bye.